Take us through these numbers. As Bonnie just said, it was 2.3%, which was better than the consensus forecast. Did it surprise you?
Yeah, it surprised a little on the upside for me because while we expect 3% growth this year or even north of it, there's been a seasonal in the first quarter that's been going back to 2010 where the first quarter tends to be almost 1% lower than the rest of the quarters in a year. And so whatever the first quarter is, if you went back to 2010 and then added 1%, then that would be a reasonable guesstimate of what the growth rate would be for that year. And so we were thinking at 3 that it might even be around 2. And the fact that it came in at 2.3 was a positive surprise. And don't forget that this quarter had 5 economically significant snowstorms, and so the seasonal effect should have even been a little bit bigger. For me, the headline is that the Trump tax policies are working exactly as intended. If you look, capital spending surged in the fourth quarter because the tax cuts were retroactive to September, and they stayed at that higher level and then even went up about the same amount in the first quarter. And, President Trump is all about getting wages up, and the way you do that is you get capital formation and then you get higher wages, right? And the capital formation is there. And so then I went down to the other part of the report, and also we got the ECI today and looked at wages. ECI growth on average over the last 3 months is the highest it's been since 2006 now. And since I like round numbers, if you go to this GDP release, the average wage increase for U.S. families over the last year was $2,900.
Yeah, well, you were an efficient economist. You just covered about everything. So let's go back over a couple of those things.
You got no questions left. Let's talk about the Olympians behind us, right?
I might have just one or two. First of all, let us in a secret. What are you telling the president about what he should expect for the rest of the year? You've said 3%. Are you telling him he's going to get that 3%?
Yeah, that's absolutely in our forecast that the average for the year will be perhaps even a little bit north of 3%. We put a hard forecast out with the economic report of the president and have seen data come in since then that are even better. We'll have an official forecast for everybody again in the summer, and you'll probably see it go up a little bit.
And what sectors is that going to come from? I mean, you said there was some bad weather in the first quarter. At the same time, there were some positive effects from inventory effects as well as trade that were aberrational.
Right.
Where is that growth going to come from? Because you're going to have to get it up from 2.3 to over 3 to average 3 for the year.
Well, if you look at what's been going on with orders and shipments of capital goods, orders have been running ahead of shipments, and there's a backlog of orders. And when somebody say orders an airplane, then they're not going to deliver it next month. They're going to probably deliver it next year. If they order a machine tool, maybe it's about 3 months. And so there's this big, healthy momentum in the orders, which suggests that the capital spending that we see in the first quarter and that we saw in the fourth quarter last year will probably even accelerate for the rest of the year. And so that's one of the major factors of the outlook. I think that the weather stuff will show up in things like automobile purchases and residential housing. Both of those were a little bit weak in the first quarter, but I think that might be weather related.
Well, and the durable goods gets us obviously into capital investment, something you and I have talked about before, terribly important to the administration, to your plan for the economy. As you say, there were a lot of aircraft orders that really helped durable goods, gave you a positive number. If you take out defense, you take out aircraft, you actually had a negative number for the month of March and on a 3-month average. Does that trouble you?
No, I think that, again, if I take the trend and what we can do is I'll come back next week and I'll bring my charts. Right. But if I look at that trend, then it's exactly on par for an acceleration of capital goods spending. And one of the things, just a economic history for me, is that when I worked at the Fed when I was a little kid, just a cub economist right out of grad school, then my job was to take the orders data and use it to project the capital spending and the GDP accounts for Greenspan. And so I've been doing this for a long time.
Well, we'll talk about capital investment numbers that we got just this morning. They were over 12%, really good, really robust, no question about it. But that was really structures. It wasn't equipment. Actually, equipment was, I think, 4.7%, which was decidedly down. And really, it was really oil and gas that was driving the structures. So are you confident about your prediction that we're going to have an increase in capital investment? Because it looks right now in some major categories we're going the wrong way.
Yeah, and it's one of the things that some folks are confused about. I know you're not, but the cost of capital for structures went down a lot because of this tax bill, because those are affected by the statutory corporate tax rate going from 35 to 21%. And so a lot of people have thought, well, we're going to see the tax effect bigger in equipment than in structures because equipment gets to be expensed and structures are not. But actually, it turns out that the rate effect is so big for structures that we expect to see a boom in both. And the structures was a little bit above expectation in Q1, and the equipment was right at expectation. And so I would guess that the equipment might even go up now, given what I see in the momentum, and the structures will probably come down a little bit.
So, Kevin, you flatter me. I'm easily confused when it comes to economics. But let me ask you specifically about why companies are or are not investing in capital investment. You obviously have really made substantial concessions to the tax code, but we already had cost of capital close to zero for most companies. Isn't it rather a question of demand, and therefore don't the consumption numbers bother you? Because it was 1.1%, which doesn't sound very robust.
Yeah, the cost of capital being close to 0 point is a common one, and the problem with it is, and it's something that I've heard left-wing critics of the tax bill make or point to. But the fact is that the big problem with the tax code as of December was that there was this big incentive to move your capital overseas and not locate it here. And so that disincentive for investment at home has been fixed by the tax plan. And that was like one of the main objectives for President Trump as we went into it. And so now people, sure, the interest rate's still pretty low, but now people don't get to avoid U.S. tax by locating their activity somewhere else. They have to locate it here. And that's why you're seeing the capital spending boom that you see. On consumption, all of the indicators for consumption are very, very strong, right? Wage growth is strong, consumer sentiment is strong, and so we expect consumption to rebound after the somewhat slower first quarter. And I think that the best theory of what happened in the first quarter is that there was kind of a blowout consumption binge in Q4, and people were basically rebuilding their savings a little bit in Q1. The savings rate went up.
Yeah, finally, Kevin, quickly, I have to talk about the deficit because we've got record issuance coming out of the Treasury here at this point. Does that worry you at all about future GDP growth?
I'm sorry, could you say it again? Because a motorcycle just blasted itself while you were saying the question.
The deficit. We've got record issuance from the Treasury coming out. We're talking about that 10-year being over 3%. Does that worry you and the president at all about future GDP growth?
You know, that if you look at the academic literature, then long-run growth is absolutely influenced by deficits, and that, deficit to GDP can get up into a range where it's a danger sign for long-term growth. I think that if spending in Congress continues to be out of control, and if we don't do anything to entitlements in the long run, that's going to catch up with us. I think, though, that the president was right in the near term to prioritize the things that really needed to be fixed, like the tax code, and that's why we're seeing GDP growth go up so much right now. And that's also, don't forget that it's not just us. It's the OECD, it's the IMF, it's the CBO. Everybody's saying that it's working right now. And with a bigger, healthier economy, we should be able to address our deficit situation down the road.